So this is a really good question, and one that kind of is really worth talking through and getting your head around before kind of you ever take the plunge and start investing yourself. I think, put simply, a cautious investor is someone that would be very uncomfortable with the prospect of a fluctuating value of the investments they've made, or even the prospects that an investment they've made could completely fail and go to zero. Whereas a high risk investor is probably much more comfortable with volatility and with fluctuating values of investments they've made. Typically, we see higher risk investors as more experienced. They've probably lived and invested through market cycles, so are familiar with how ups and downs can affect the prices and the values of the investments they've made. And probably they have a slightly higher capacity for loss. If they're able to more easily withstand a loss on an investment within their wider financial circumstances, they're often likely to want to take on slightly more risk than an individual that doesn't necessarily have a greater capacity for loss. This isn't always the case at all, in fact, and you know, an experience and a high level of wealth doesn't always translate into wanting to be a higher risk investor. I've seen many times over the years entrepreneurs and business owners who take huge risk on in their professional lives and don't wish to do so with their financial investments. So that just because you have some experience and a few grey hairs and a high level of wealth doesn't mean you necessarily want to take huge risk with your investments. When it comes to assessing your circumstances, I would urge that you speak to a professional advisor about assessing the right level of risk for you and really what the process will be there. And we talked about this in earlier videos. If you decided to invest, it needs to trigger a chain reaction and a process of working out what's right for you. And talking to an advisor about risk levels is going to be really a blending together your natural attitude towards financial risk, or your emotions towards financial risk, your wider circumstances, other savings and investments you have, income levels you have, the prospects for the investments you want to make, and really your timescales. Again, the longer you have investment horizon you have, the more volatility and kind of more risk you can potentially weather within a portfolio. And normally, once that process is unfolded and you've kind of worked out what the right level for you is, what you tend to see is that in higher risk investor portfolios, you will see a greater exposure or proportion of investments made into more volatile asset classes, equities, for example. Whereas for more cautious investors, what you typically see is a greater proportion of portfolios or higher exposure to less volatile asset classes, cash or bonds, for example. And that's just by kind of nature of an individual's stomach, if you want of a better word, for volatility and changing value of portfolios. There is no one measure for how much risk you should take on, and you may put more or less upon timescale or natural attitude than other individuals. So sit down with an advisor, work out what's right for you, and that is the best way to ensure that you're not taking on too little or too much risk.